Just over a month ago, Elon Musk's SpaceX pulled off one of the biggest IPOs in history, launching on the NASDAQ at $135 a share, briefly hitting a staggering peak over $225. Fast forward to today, the hype has officially evaporated. SpaceX has officially broken down and broken below its IPO price, dipping into the 120s. But if you've been waiting on the sidelines to own a piece of the world's dominant rocket and satellite empire, this fall from grace isn't a reason to panic. In fact, I believe it's a massive opportunity. In this video, I want to break down exactly why Wall Street is suddenly dumping SpaceX and a professional option strategy called a cash secured put that will allow you to get paid cold hard cash just for naming your own lower price to buy the stock. Hey everyone, welcome to Patterns and Profits. I'm Tom Gentile, America's #1 pattern trader who is constantly looking for patterns that repeat and profits that add up. Now, if you follow me, then you know we did a video on SpaceX months ago when it was IPOing, where I discussed the patterns of high-profile IPOs and the pattern of falling shortly after going live, as well as how to buy them on the cheap. So, what happened to SpaceX? Well, the decline really boils down to what I think are three primary pressures. Number one, the AI reality check. So to go public, SpaceX absorbed Musk's XAI startup. While AI is the most ultimate buzzword, it comes with a massive price tag. Critics point out that SpaceX's valuation hit over a 30x forward price to sales ratio while carrying a multi-billion-dollar net of losses. Next, there's a massive debt load out there. I mean, SpaceX tapped the bond market for $25 billion to fund the AI infrastructure. Wall Street is fiercely debating how long it's going to take to see a return on that capital. And finally, you've got what's called the impending lockup expirations. Now, between August and September, the initial post-IPO lockup windows expire. This means early investors and employees can finally liquidate their shares. And, they're worried that's going to threaten the market with supply. Retail momentum, as we know, is cooled. Institutionals are short selling. That's what's causing the stock to slide. But underneath the noise, I believe Starlink and the core launch business remain incredibly valuable. If you want to buy SpaceX, but you think it could drift lower toward, say, around $100 a share, you don't just sit there and sell a good till cancel limit order. You want to use something called a cash secured put instead. Think of that cash secured put selling as acting as an insurance broker. You're agreeing to buy 100 shares of SpaceX at a specified price, which is called a strike price, by a specified date, the expiration date, if the stock dropped below that level. Now, in exchange for taking on that obligation, the buyer is paying you an upfront fee called a premium. Here's exactly how the mechanics look. So this is a recent setup with SpaceX at $125. Let's say your target price is $100 and the premium you're going to collect is $10 per share. That's $1,000 per contract total. Your capital required is going to be $10,000. That's kept in cash to secure the trade. You're instantly pocketing a $1,000 premium, which represents 10% of the premium capital locked up to secure the stock at 100. That's yours to keep no matter what, and no matter what happens next. Now, let's look at two scenarios that will play out by expiration so that you understand the risk to reward profile. Okay? Scenario A, SpaceX stays above $100. That means the put option expires worthless. You keep the $1,000 premium. You get 100% win. You didn't buy the stock, but you generated a 10% return on that cash that was secured. You can repeat the process. Or scenario B happens as SpaceX drops below 100, you're legally obligated to buy the shares at $100. Is that a win? Well, you do own the stock at your target price, and your cost is basically $90, which is a $100 strike minus a $10 premium that you brought in for the shares. All right. Now, let's talk about the genuine risks. If SpaceX suffers a catastrophic failure, or maybe they get a big earnings miss, the stock is likely to plunge. What if it plunges to 80? You still have to buy it at 100. You're sitting on an immediate unrealized paper loss. This is only why I sell cash secured positions on companies that I'm fundamentally happy to own for the long haul at that strike price. The key to winning with cash secured puts on high implied volatility assets like SpaceX is one word: patience, right? Allows you to take advantage of the post-IPO panic instead of being a victim of it, which so many people are at this time. Are you looking to scoop up SpaceX down here, or do you think the stock has further to fall before it hits its true bottom? Let me know your target price in the comments below. Also, don't forget to hit that like button and subscribe and ding the bell for more institutional grade trading strategies. And I'll see you on the next one.